Hello, podcast listeners. We know podcasts are a great way to catch up on a program that you may have missed on KSJE, and it's provided as a free service of this radio station. But you know, KSJE is now listener-supported, and so while you enjoy this podcast, we hope that you'll also take some time to join KSJE. Become a member today. It's quite easy to do. Just go to our website at ksje.com/support and pick the level of support that best matches your budget. Thanks again for listening. Here's your podcast. The material discussed in this program is for information purposes only. It is not intended to be used as a recommendation for investing or as legal advice. Each person has his or her specific situation, circumstance, and objective, and should consult their own personal advisor or counsel. Time for our Save a Buck Thursday segment. Jason Calcote is joining me here from Citizens Trust and Investment Corporation. Jason, good morning.
Good morning.
Thanks for coming in. Appreciate it. There's been a lot going on since we last spoke.
There has. Yeah, it's been a
Didn't know
weeks.
our show just, impacted the market so much and the economy, but apparently it does when you're not here.
That's right.
So what's going on?
Well, to kind of reverse into last week,
Yeah.
we had this yield curve inversion last week.
Right.
It was on Wednesday that it happened. And a full yield curve inversion has not happened since 2007. We had a partial last year.
I thought I remember asking you maybe in December or something about it, right? Then the people were all a little worried. So, okay, and here we go again.
So partial last year, that's where we've got the 2-year bond yield, the 5-year bond yield, and the 10-year bond yield that we really look at for the yield curve.
I see.
And the 5-year fell below the 2-year. So that's a partial inversion. That's what happened last year. But this time, last week on Wednesday, we had a full yield curve inversion where the yield of the 2-year is above the yield of the 10-year.
Right.
Which is not supposed to happen.
Right, and that freaks everybody out to a certain degree, right?
It does.
And
It does.
Maybe in some circles people think it's a precursor to the R word.
Right. So there's been 5 inversions of the 210 since 1978, and each one of those were a precursor to a recession.
The R word. Okay.
The R
you
word.
said it, I didn't.
I know.
Okay.
I know. But
okay.
it's okay. The average time usually between the inversion and the recession is about 22 months.
Okay.
So it's not automatic doom and gloom. And
Right.
really, interestingly enough, the S&P actually enjoyed average returns of about 15% up to 18 months after the inversion. So it's not really an indicator of everything coming to a screeching halt.
Right. But not good.
But
you don't want to.
the signal did spook investors. The markets fell about 3% across the board on Wednesday.
Okay.
And really, when the yield curve inverts, that's the bond market signaling that they're not sure what's going to be happening 10 years down the road. The long-term growth is not really there anymore. We're looking for a slowdown, and the long-term economic outlook is no good.
Okay. Now, that was last week.
That was last week.
Now here we are this week.
Let's fast forward to this week, okay? So we've got...
Short memories, I guess, of these
exactly,
people. I don't know.
Exactly. So the markets this week now, if we could pull up...
Yep, there's
a
Dow
chart.
Jones.
Okay. So the Dow Jones, you can see...
Up 157 recently,
we
right?
Opened up big again today, and you
Yeah.
can see that dip right at the end of the chart.
Yep.
That was Wednesday, and we're right back where we started, and actually above where we started.
The line is green for year to year, so there you go for the Dow Jones. And if we go to the other indexes, the S&P, as you mentioned, right?
Yep.
Same thing, right?
Should be the same thing across the board. Yep. This is really just shows you how the buy and hold strategy can work and how to not panic.
Right.
When something like that happens.
NASDAQ, same thing.
Same thing.
Right?
Yep. We've got that big dip, but we're right back where we started from. This week has all been good.
Right.
And all the news has been good. So really.
And again, this is one of those things that you say you can't play the market day to day.
Right.
If you try to watch it, you'll go crazy.
That's exactly right.
But this is what this kind of shows too, is just how quickly things can reverse itself, I suppose, to a certain degree. And we'll see in the long run what happens. But for right now, here's where we are.
Yeah. No, it's a big example of how you cannot time the market. You can't jump in and out of there trying to time these little dips. So really now we need to look at what's driving the market. Is it our domestic economic numbers, or is it more of a global picture that's moving everything? So the Fed minutes were released yesterday.
Okay, from their meeting back a few weeks ago, right?
Yeah, where they cut the interest rates. Confirmed the statements by Powell afterwards, saying this was more of a mid-cycle adjustment and not really the start of a rate cut cycle.
Okay.
Which is what we would expect to see if we were heading into a recession. You'd expect to see the Fed to start steadily cutting rates. They've come out and said that this is not the case. This is a mid-cycle adjustment. However, Wall Street right now is pricing in another rate cut in September. So they meet on September 18th.
Okay.
The market's all but sure they're going to cut them again.
Interesting.
So yeah, again, a lot of the analysts are thinking it would be a 2 rate cut scenario. So this can still be considered a mid-cycle adjustment if they cut it twice.
Right, and we're expecting another 0.25, right? So that'd be a total of half a point.
That's right. That's right.
After these 2 cuts.
That's right. And so the Fed cutting these interest rates, if you look at the economic numbers of the U.S., everything's fine.
Unemployment, right? Inflation, all these things that we look at, right?
Yep, we've got these strong numbers that came out from Target and Lowe's and
retailers.
There
you go.
Scott.
Yes, that's okay.
That's
the other R word. We're talking about R words all morning, so I understand.
Right. But no, Target, Lowe's, Home Depot, they all came out with strong numbers.
Yeah.
These numbers tend to boost consumer confidence because it's a good indicator of how everything's doing. Consumer confidence is, again, kind of the degree of optimism that consumers feel like the overall economy looks like, and then their personal financial situation as well.
Okay.
The U.S. existing home sales were up 2.5%.
Now those are your realtors.
Those are the realtors. That's what I was skipping ahead. And then another thing that came out, Trump, if you'll remember, a few days ago or maybe last week, came out and said that he was thinking that the government should cut payroll taxes. As sort of a stimulus.
That was yesterday, right?
Was it yesterday?
I think it's different today.
Well, it is. He came out and said that he decided that that's not the case.
Okay.
So again, kind of backtracking on this financial stimulus stuff that he was kind of preaching earlier.
Okay.
So we're doing okay. So the real theory now is that the Fed may be cutting interest rates because we've got this global scenario where rates are so low, sometimes even in negative territories,
right?
That these foreign bond investors are actually looking for somewhere with yield. And the U.S. is the only place to go.
Positive, right.
Positive. So the Fed is thinking, well, we don't need to pay them that much interest because they're going to be coming here anyway, so we're going to cut our interest rates, and we're still going to see this influx of foreign investment. So
interesting.
Maybe less to do with what's going on domestically, again, and more to do with what's going on in the geopolitical scene right now.
Right. Interesting. Now, I do want to ask you real quick in the time we have remaining about Germany, because that is another concern. They are, I think, the biggest economy in Europe, or one of the biggest.
One of the biggest in Europe.
And they're tipping towards the R word.
They are.
And I don't mean realtor.
I
mean recession.
Recessions, yeah.
Yes,
the realtors
sir.
are probably having a tough time in Germany right
now. But is that a concern then?
Definitely.
That could trickle over
Definitely.
and infect other economies, especially in the EU?
That's exactly right. You've got the EU, some of the strongest economies in the EU are moving towards zero or negative interest rates. And that's affecting the whole region. And then on top of that, we've got Brexit coming right down the pipeline.
Right.
So another really big shakeup in the Eurozone right now. And then, again, there's destabilization in Asia right now, too. We've got Japan that's struggling. China, really, this trade war with us is starting to kind of take its toll on them as well.
Okay.
So hopefully when we meet with them again, we can get somewhere this time.
Right.
And then we've got all the destabilization in the Persian Gulf as well that's kind of affecting the oil prices right now. Oil hanging around $55 a barrel.
Okay.
Which is not bad, not the worst that we've seen.
Right.
But there was a drop in the U.S. stockpile that's helped kind of balance out the fears of the global really growth slowdown. But it is down about 18% from the high in late April.
Interesting.
So yeah, starting a little bit of slide there too.
Okay. Well, we'll see what happens.
We'll see what happens.
We will check with you next week.
Okay.
Jason, thanks so much.
Thanks for having me.
You're welcome. That's Jason Calcote, everyone, from Citizens Trust and Investment Corporation. He is with me on Thursdays here to talk about the economy right here on KSJE Farmington. Did you enjoy that podcast? We hope that you did. And if you did, share it with your friends. And if you really want to keep podcasts like this coming, please support KSJE. You can do it easily online at ksje.com.